So all that being said, as far as some of the technicals on the market, because it's rallied so strong, the volatility index has came down quite a bit, which I say is a positive technically. We got as high as 88 on the VIX, and we came down now all the way to 28, which is telling a lot of fear has left the market, and that's actually a positive technically. And the ROC, which I mentioned in previous videos, get that up here. I said if it gets below -20 and then comes back above -20, that's a buying opportunity. So, and this never really did signal a bull market because the recovery was so fast. It got back to -10 and now it's plus. So it's kind of not signaling a bear market anymore. We're getting close to. And the moving average, which I mentioned, I talked about the death cross there, where the 200-day crosses over the 60-day. That gives a strong sell signal, and then you wait for the reverse to happen. The 60-day across the 200. And that hasn't happened yet, so this is still indicating a bear market. But when we have a retracement like we've had, you almost got to say we have had a mini bear market coming off the bottoms, which is confounding a lot of people. But again, it just comes back to the Fed and printing so much money, putting so much liquidity out there. So long term, I'm still thinking that these markets are going to come back down, especially if we have a second wave. Even before all this happened, a lot of technical indicators, economic data and stuff I look at was indicating an earnings, I'd said even a few months ago, had been flat now for a couple of quarters, and the market is kind of a derivative of earnings, right? Higher the earnings, the higher the market. So the market in a lot of ways now is even pricier, quite a bit pricier, because we know the earnings are going to go down for sure over the next couple of quarters. But getting back to, I bought some more. Again, these are safe kind of dividend plays till we see how everything plays out. And again, I will sell these if I go into a small loss on them. As I've always said, I never want my capital losses to take away from my dividends received. So, but I bought TransAlta Renewable, symbol, well, I should say I added to TransAlta Renewable, VNR.T. It's a renewable energy company. I've mentioned about this several times in the past. I've traded it, done quite well on it, and it's trading at it's got a 6.7% yield. The new company I bought was PPL Corp. It's another electrical generation company, and I'll just bring up the chart for that. So we can see here long term, the stock did correct quite a bit back in 2009. It got as low as about $22. It was kind of rising up to 40. Had a correction in 2018, back to around 27, and then all the way back up to 36. I was able to buy it at 25. It did dip down to 19, and it's been pretty stable there. So there is a chance it could, move back up to the $29, $30 range, give me a couple percent capital gain on top of the Morningstar has a 3-star rating on it, which is kind of the middle of the road, and they have a price target to 27, so about 8% or so above where it's trading at now. But it has the highest dividend yield for utility company in the United States, and the yield is 6.77%. And like I say, if the market slowly recovers over the next couple of years, you might get 2 or 3% capital gain on top of that, which would give you close to a 9 or 10% return. So its guidance for 2020 is $2.40 to $2.60. This came down a little bit because of COVID-19. The PPL is a regulated utility. I kind of like the regulated utilities because the contracts with the municipalities or the towns or the states, sometimes are maybe for 10 years, and they use the kind of an escalator clause in there for inflation, so your dividends are going to be pretty secure. And it's got 3 subsidiaries. It's international regulated delivery segment, which is the UK, which is more the transmission lines, the transmission network, so the electrical grid, providing electricity service to customers in the United Kingdom, and the same thing in Pennsylvania, regulated delivery and transmission segment, provides distribution to customers in central and eastern Pennsylvania. And then in Kentucky, they do have generation, transmission, and distribution there. Total of 10 million customers, so this is actually a very large utility. And they have 12,000 employees. The return on equity is about 13%, which is pretty good for a utility. And its P/E ratio right now is pretty low at 10%. So the main focus on this, of course, is the dividend. It's $1.66 per year right now. And back in 2010, it was $1.40. So it has increased very slowly, probably about the rate of inflation. And I also like that the dividends have been paid out every year for like the last 15 years or so. And their dividends are 68% to net profit. So pretty conservative dividend payout. And there are a few negatives. I looked at their 10K, which is the annual report that you have to file in the United States, and you can get that through all these filings in the States. You just Google sec.gov, and then every company filing will be there. So insider sales, major news announcements that could affect earnings, 10Q, which is your quarterly reports, and 10K, which are your annual reports. So everything is there and available. And so going through that, they did have quite a bit, if I remember correctly, about $7 billion in defined pensions. So this isn't a defined contribution plan, this is a defined benefit plan. So that means typically it's something like 2% a year times years of service. So somebody works for 30 years at 2%, they end up getting 60% of their pay. And so they have to account for that. So if we were to have, and now because bond yields are so low, a lot of that's invested in equity markets. So if the markets were to fall a lot, they would have to make up that money in the pension plan, and that could affect earnings quite a bit. So that was a bit of a negative. So they got about 4% base rate growth, and again, anytime you got international company that's international, you got FX concerns, so currency risk from UK, especially now it's exited the European Union. and they do not hedge their currency. So if the pound was to weaken quite a bit, that means the money they generated in England would be less in American dollars, and then the earnings per share would be less. And just recently in England, I don't know, because maybe the economic times aren't as good, but the regulators, so lower regulated returns in the UK regulators suggest moving towards a 4% allowed return on equity rates for gas transmission utilities starting in 2021. Now this is for gas utilities, not electrical utilities, but there is a concern that this might be rolled out for electrical utilities. So then their rate of return would be lowered. So have to keep an eye on that. Another negative is in Kentucky. They do have 5.2 gigawatts of electrical coal production, and there's the whole carbon tax and everything else, that environmental regulation, that type of thing. If these plants were forced to be shut down or something, they would be compensated in some way, but again, it could be negative overall.